This session on you and your pension is part of Essex County Council's financial wellbeing campaign, but it's also part of the National Pension Awareness Week. We're joining with pension funds and other pension organisations across the UK, asking everyone to pay their pension just that little bit more attention. We want everyone to be confident that they know how much they're saving for their retirement and that they know how their pension works. So, what are we going to cover today? We're going to be looking at some of the key features of the LGPS. We'll explain how it works, how you can change how much you pay in to give you greater flexibility when it comes to balancing today's necessities with saving for your future. We'll also be touching on when you can retire and answering some of the questions that you've been emailing in for the last couple of weeks. So let's get started. What's a pension? Basically, it's a tax efficient way to save for your future, and it provides you with an income to live on after you retire. You get tax relief on your pension contributions as these come out of your salary before income tax is deducted, so that reduces how much tax you pay. As the LGPS is an occupational or workplace pension scheme, both you and your employer contribute, and your employer bears about 2/3 of the cost of the scheme. Your pension is safely and securely locked away until you reach retirement age, and you can't access these funds until then unless you are retired on ill health grounds. So let's look at some of the key benefits of the LGPS. The LGPS is one of the biggest schemes in the UK. It's made up of 86 local funds across England and Wales who administer the scheme in their area. So, Essex Pension Fund is just one of these funds, and obviously, we administer the LGPS in Essex. I just want to take this opportunity to reassure everyone here that your LGPS pension is completely secure. I know there's been a lot of really scary headlines recently talking about how pension funds are in danger of going under because of the turbulence caused by the mini budget. But I just want to assure you that your pension is fully protected and is absolutely going to be there for you when you retire. In part, this is because the LGPS is a defined benefits pension scheme. This means that your pension is not linked to the contributions that you and your employer pay and is not linked to stocks and shares. So this volatility in the stock market, it doesn't impact on the value of your pension benefits at all. Instead, your pension is calculated using a set formula and it's guaranteed to be paid to you for life, no matter how long that is. We're going to look at how your pension is calculated a little bit later. So, what happens to your contributions and your employer's contributions then? Well, Essex Pension Fund does collect these contributions and we invest them to ensure that we can pay out all the pensions and all the death benefits that we have guaranteed will pay. Essex Pension Fund itself is very stable and a well diversified fund. The fund is currently worth about £9.5 billion. And while it did lose out on some investments in the wake of the mini budget, we actually made up for it in others. So it didn't cause us any problems at all. Also, you have the ultimate protection to your pension because the LGPS is a statutory scheme and therefore it's fully protected by the government. In the incredibly unlikely event that something horrible befell our fund and we fell into a black hole and we couldn't meet our responsibilities, the government would have to step in and they would pay your benefits, your pension benefits to you on our behalf. So I hope that's reassured you that you're in one of the safest and most stable pension schemes in the UK. And regardless of whatever chaos is going on with the economy, your pension is one thing you do not have to worry about. Okay, I'll get back to the key benefits. So I already said, but just to recap, the LGPS is a defined benefits pension scheme. So your pension is not linked to you and your employer contributions or stocks and shares. Instead, it's based on a guaranteed formula based on how much you earn. It grows in a steady and reliable way, and once you retire, it's guaranteed to be paid to you for life. But that's not all. Your pension is also index linked to the Consumer Price Index, or CPI. This means it's protected from inflation, as a cost of living increase is applied every April. The increase is usually in line with September's CPI rate. However, the rate we use is actually determined by the Treasury, and they don't make their official announcement until about February. So once we know what next year's increase is going to be, we will let you know. You also have the option to take tax-free cash when you retire. So you can swap part of your pension in order to take a tax-free lump sum. For every £1 of your pension you swap, we'll add £12 to your tax-free lump sum. So this can be a really useful option for doing things like paying off that last chunk of your mortgage or doing some renovations around the house. But it's your money and you can do whatever you want with it. Take a trip around the world to celebrate your retirement. It's entirely up to you. But when can you retire? Well, that's up to you too. You can retire at any point between ages 55 and 75. But if you take your pension before you reach your normal retirement age, so this is the later of either age 65 or your state pension age, your pension will be reduced for taking it early. Your LGPS pension also comes with ill health retirement benefits. This means that if you are no longer able to do your job because of illness or injury, your employer can choose to retire you on ill health grounds and will pay your pension to you straight away, regardless of age. Ill health retirement is wholly an employer decision. It's not something the pension fund gets involved with. We just get notified once the retirement has been agreed and the date that is going to happen from, and that's when we get involved and start sending you information and forms to get you to start claiming your pension. There are three tiers of ill health retirement based on how likely you are to recover and return to work. And in the case of the top two tiers, your pension is actually enhanced. So, for the most serious tier, so tier one is the most serious cases of ill health retirement where you're not expected to be able to return to gainful employment before reaching your normal retirement age. Your pension in these cases it is enhanced to that which it would have been if you had been able to stay in the pension scheme up to your normal pension age, based on your current pay and working hours. So that's quite a generous increase. Your LGPS pension also has redundancy protections. This just means that if your role is made redundant when you are 55 or over, your pension has to be paid to you immediately without any reductions for early retirement being applied. So you get the whole pension that you've accrued up to the date that you leave employment. The LGPS also automatically includes life cover for your next of kin, so you have that peace of mind that they're going to be taken care of if anything happens to you. The death benefits are made up of two parts: a one off tax free lump sum, which is known as a death grant and can be paid to whomever you choose friends, family, even registered charities. If you die in service, the death grant is calculated as 3 times your annual pensionable pay. As it falls outside of your estate, it can be paid quite quickly and it doesn't usually attract tax. There are also pensions payable to your spouse, civil partner, or eligible cohabiting partner if they meet the qualifying criteria, and that's paid for the rest of their life. There are also pensions payable to dependent children up to the age of 18 or age 23 if they stay in full time education. You don't need to nominate anyone to receive the dependents' pensions. The recipients of these are determined by law and they can't be transferred to other people. So if these pensions become payable, we just reach out to your next of kin and determine whether anyone is due to receive a pension from our fund. Just want to take a quick look at the nomination form in a little bit more detail as it's an important topic and one that we get a lot of questions about. You can nominate anyone to receive the death grant by filling in an expression of wish form, which is available from the resources section of our website, essexpensionfund.co.uk. If you select um, forms from the type drop down menu, which is right next to the search bar, it actually brings up all the forms we're going to talk about today. So yes, you can nominate whoever you'd like, and you can nominate more than one person. You just need to tell us how you want the funds to be split out between them. So 50-50, 60-40, doesn't matter as long as the total comes to 100. Essex Pension Fund has complete discretion over who the fund is paid to. Um, so, but we always make sure to take your wishes into consideration when we make our decision. So it's really important that you keep your nomination up to date. Be sure to review your nomination, especially after significant life events such as getting married or divorced or having children. The form must be signed by hand so that we know that your wishes are your own. We can't accept a typed or electronic signature on this form. This is just in case there's ever a dispute about your wishes after you've passed away. However, you can email the completed form back to the fund rather than popping it in the post. So you can either scan the form or you can take a clear photo of both sides of the form and then add the images as an attachment to an email. Or if you registered for Member Online, which is our online platform, you can actually change your nomination details at any point by logging in and going to the My Personal Details section, and then you just need to follow the instructions on screen. So let's move on to how the pension scheme actually works. First up, we're going to look at the current pension scheme, which is the Career Average Revalued Earnings or CARE scheme. This started on the 1st of April 2014. So I mentioned earlier that your pension is calculated using a set formula. And with the care scheme, it's really simple. Every year, your employer tells us how much you earned between the 1st of April and the 31st of March. So this includes your basic salary, any overtime, plus things like bonuses and pensionable allowances. It doesn't include anything that you don't pay pension contributions on, so things like expenses or payment in lieu of holiday. We take that annual figure and we divide it by 49, or 98 if you're in the 50-50 scheme, but more on that later. Then we add this to your rest of the pension that you've already built up, and then we revalue the whole pension amount by inflation. So, as an example, if you were paid £25,000 over the year, we divide that by 49. This means that you've built up £510.20 pension. So it's worth pointing out here that this is not a one-off payment. You've built up £510.20 that'll be paid every year from when you retire for the rest of your life, no matter how long that is. So we add this amount to the pension you've already built up. So in this example, this person's already been in the scheme for a couple of years and they've already built up a pension of £2,655.12 annual pension. So we add the £510.20 to it, and then we revalue the whole pension to protect it from inflation. So in this case, it's 3.1%, and that gives us the total pension amount of £3,263.44 per year. So I said it's pretty straightforward, and this is what we mean by how it builds up in a steady and reliable way. Because if you know roughly what you're going to be paid and how long you think you'll be in the scheme, you can give yourself quite a good idea of how much pension you're going to earn. But before the care scheme, so before the 1st of April 2014, the LGPS was a final salary scheme. So let's take a look at that. If you joined the LGPS before the 1st of April 2014, then you have pension benefits in both schemes, so both the final salary and the care scheme. This just means that the parts of your pension are calculated differently. So we calculate each element of your pension separately, and then we add them together to give you your total pension amount. The final salary part of your pension is calculated using your length of membership in the scheme and your final salary when you come to leave employment, and this is multiplied by a rate of accrual. The rate of accrual changed in 2008, so if you joined the LGPS before 2008, you actually have three elements to your pension. The important thing to be aware of with the final salary scheme is that your length of membership in the scheme is not necessarily the same as your calendar length in the scheme. If you worked part-time or term time, then your length of membership has been proportioned to reflect this. The length of membership also only takes you up to the 31st of March 2014 when the final salary scheme closed, as the pension you've built up after that date is in the care scheme. The final salary is also based on your whole time equivalent pay figure for the last 365 days of your employment. So this means that your employer has to tell us how much you would have earned if you worked full time hours over the full 52 weeks of the final year of your employment with them. So if you have a pay rise midway through the year, your final salary will reflect both the months that you're on your old rate of pay and the months that you're on your new rate of pay, rather than just the rate of pay that you were in receipt of on the day you left. It also means that the final salary part of your pension isn't actually calculated until you leave employment. But we include figures in your annual benefit statement every year based on your current whole time equivalent pay figure, just to give you an illustration of how your pension is growing. Because your final salary pension is calculated using the whole time equivalent pay figure, if you want to reduce your hours as you start to move towards retirement, so maybe you want to drop a day or something, this doesn't impact on the pension that you have already built up in the scheme because the part time pay won't impact on your final salary pension benefits at all. Just means that going forwards, you'll build up less pension than you otherwise could have. So let's have a look at an example of how the final salary scheme is calculated. And this is for membership that's built up between 2008 and 2014. If you had 4 years and 200 days membership in the scheme, we multiply that by your final salary, which we're going to say here is £25,000. And then we multiply that by the rate of accrual that applied in that period, which was 1/60th. This gives us an annual pension of £1,894.98 per year pension. So again, not a one-off amount, paid every single year. Moving on to the pre-2008 final salary scheme, you'll see that the same formula applies to calculate this part of your pension benefits, but with two key differences. Firstly, the rate of accrual for your pension was 1/80th, and secondly, that you built up a separate tax-free lump sum at 3/80ths. Until the 31st of March 2008, members of the LGPS built up both a pension and a tax-free lump sum. That all changed because we wanted to give members more choice over how to take their pension benefits. So from 2008, scheme members have built up more pension, getting 1/60th instead of 1/80th. And instead of having to take a tax-free lump sum when you retire, it's become a choice. You can choose to exchange part of your pension and take a tax-free lump sum or not if you don't want to. Just to clarify, if you've already built up an automatic tax-free lump sum, you do have to take it when you retire, but you can still have the option to swap some of your pension to increase the size. The changing rate of accrual trips up a lot of people. So I just want to look at that for one moment. When people think, hang on a minute, if the rate of accrual, the numbers are getting smaller, how is my pension getting bigger? You've got to keep in mind that rates of accrual act like fractions. So let's go back to that classic example of having a cake that you need to divide up into a certain number of slices. If you have a cake and you need to divide it into 80 slices, those slices are going to be pretty small. If you only have to cut that cake into 60 slices, those slices are going to be bigger. You're going to get more cake there. And if you have to slice it only into 49 pieces, well, much bigger again. So you see, as time's gone on, you've been getting much more pension for your money. Again, if you are in this part of the pension scheme, we do just calculate this separate element with your other elements of your pension, add it all together to give you the final amount when we tell you how much your pension is worth. Now, the most important question, and the one we hear most frequently: when can I retire? So, as I said earlier, you can choose to retire and take your pension any age between 55 and 75, but there are a couple of things you need to keep in mind. Number one, the LGPS is an occupational scheme. This means your pension is linked to your job. You have to retire from your job to access your pension. You can't just opt out and start having your pension paid to you. Um, the only exception to this is if your employer permits what's called a flexible retirement. This is where you reduce your hours or you move to a less senior role to start easing you into retirement. Then your employer tells us that we need to bring your pension into payment to kind of make up that shortfall in your wages. Your employer will have their own policy on when they will consider a flexible retirement request and how big a drop in hours you need to take to be eligible. So if you are interested, just speak to your HR team in the first instance and they'll get the ball rolling for you. If you retire and take your pension before you reach your normal pension age, so again, this is the later of either age 65 or your state pension age, then your pension will be reduced for taking it early. However, if you leave your pension, say a couple of years after your normal pension age, then a very small enhancement will be added to your pension. Your pension must be paid to you before you reach your 75th birthday, even if you're still working. I know, I shouldn't have put that image in your head. But if that did happen, we would just take you out of the pension scheme 2 days before your birthday so that we can start paying it to you. The other thing to be aware of is that the UK government dictates things like the state pension age and the earliest point that you can access your pension benefits. If they make changes to these ages, then we have to comply with that because we can't overrule the government. And the government has announced that it does intend to move back the earliest retirement date from 2028. So from 2028, you will no longer be able to access your pension at 55. It's being pushed back to 57. We expect this legislation to be applied across all UK pension schemes, and that will include the LGPS. And we'll keep you posted as we find out more about this. Of course, if you're ever retired on ill health grounds, there is no minimum age limit, as anyone can get sick or be injured and end up unable to work. You just need to have at least 2 years' membership in the fund to be eligible. So now we know what the key benefits of the LGPS are and how your pension is calculated. But what if you're looking at your annual benefit statement and you're thinking, you know what, I might need a little bit more to live on? How can you save more for your retirement? There are two ways, and they work in two slightly different ways. So the first up is additional voluntary contributions, or AVCs. So this is where the contributions come out of your salary, so you still get tax relief, but instead of coming over to Essex Pension Fund, they're paid over to your chosen ABC provider, which will either be Prudential or Standard Life, and they invest your contributions for you. AVCs are quite flexible. You can decide to stop paying in, restart, or change how much you want to pay in whenever you want. But the downside is it's an investment product, so you don't know what you're going to get on retirement until you get there. It depends entirely on how much you've paid in and how well those investments have performed. But when you retire, you get a whole range of options for how you can take your AVC fund, including you may be able to take some or all of it as tax free cash. You can use it to top up your LGPS pension. You could even take the entire AVC fund to an insurance company and you can buy an annuity. It's whatever meets your needs at that time. If you choose to top up your LGPS pension, you automatically increase your death benefits. If you purchase an annuity, you get to decide whether you want to include death benefits for your next of kin. The other way to save extra is through additional pension contributions, APCs. APCs offer a more predictable but more rigid way of saving more towards your retirement. You can buy up to £7,352 a year extra annual pension, the cost of which will depend on your age and gender. This sometimes confuses people. We do get a lot of questions along the lines of, but if I've paid in £5,000, why hasn't my pension increased by £5,000? Well, it's because you're buying annual pension, not a one-off payment. If you could pay in £5,000 one time and then get an extra £5,000 every year for the rest of your life, I think we'd all do that. Instead, they're not quite that generous, I'm afraid. There is a calculator on the National LGPS website, which is lgpsmember.org, and you use this to find out how much it'll cost you to buy extra annual pension. You can pay it as a one-off lump sum, or you can agree to pay a fixed monthly amount over a set number of years. And tax relief again is applied to these extra contributions that you're paying. So the great thing about APCs is that you know from the get-go how much your extra pension you're buying and how much it's going to cost you. But you do need to keep in mind that you cannot change the amount that you are buying. You can stop the contract early if you want, and you'll be credited with the amount of pension that you've bought up to that date. But you can't restart the contract later. You could start a new contract, but you need to keep in mind that the cost of buying the extra pension is related to your age. The older you are when you start the contract, the more it will cost you to buy the extra pension. You also need to keep in mind two further things when buying APCs. First, it doesn't buy exactly the same kind of pension in the LGPS as you build up through your employment. For example, there are no death benefits attached. You are buying extra pension for yourself only, and the extra pension dies with you. Secondly, it can feel like quite an expensive way to buy extra pension. This is because you're paying the full cost yourself. I said right at the start, your employer bears about two-thirds the cost of the scheme. And while you can ask your employer to contribute towards any extra pension that you're choosing to buy, it's extremely unlikely that they'll agree. So instead of you paying the usual one third of the cost that it costs you to contribute towards your pension, you're actually paying for the full whack yourself when you're buying extra pension through APCs, and that can make it feel a little bit pricey. So there are two ways to pay in more, but we know that especially at the moment that lots of people are trying to find ways to save money. So how can you pay in less? Well, you can switch to the 50-50 scheme. This is where you pay half your usual amount in contributions, and in turn, you build up half the usual amount of pension. But the key thing about the 50-50 scheme is that your death in service and ill health retirement benefits remain at their full value. What do I mean by that? Well, your death in service death grant is still calculated as three times your annual pensionable pay. It doesn't get halved. Your ill health retirement pension can still be enhanced if you are tier 1 or tier 2 ill health retirement. That enhancement is also based on pensionable pay figures. It doesn't get halved because you're in the 50-50 scheme. You can switch into the 50-50 scheme just by completing an election form, which is on the resources section of our website, essexpensionfund.co.uk. You just need to complete it and hand it back to your payroll department, and they'll arrange for your contributions to be reduced. You can switch back into the main section whenever you want just by completing another election form. Of course, you can also opt out entirely. The benefit of staying in the scheme, along with ensuring that you are still building up pension for your retirement, is that you maintain the life cover and protections that come with your pension benefits, so you keep your security net intact. Your employer is required to bring you back into the main scheme every 3 years, but they will tell you when this is due to happen. So the idea is that you take a moment to consider whether staying in the 50-50 scheme is the best thing for you or whether you're ready to return to the main scheme. If you do decide you want to stay in the 50-50 scheme, that's fine. You just need to fill in a new election form. As I said, you can opt out of the scheme at any time, but you do need to be mindful that along with no longer building up pension for your future, you won't have your death and service benefits anymore. So you should check that you have life cover and critical illness cover in place elsewhere before you opt out. You also need to know that while you can absolutely choose to opt back into the scheme at any time, when you rejoin, you'll start a brand new pension. And this can't usually be linked to your old one. So your old pension's still safe and secure. So this will impact on things in the future. Cases like if you were made redundant when you're 55 or over, your pension's paid to you unreduced, but only the pension that you're currently paying into, not your old pensions. So maybe not a major thing, but something to have in the back of your mind when you're making these decisions. So the 50-50 scheme, it just gives you that extra degree of flexibility. It cuts down on your expenses when you need to find a little extra money for things like energy bills. But it means that you're not giving up on your security of being in the pension scheme when times are tough. So, what do you need to do to keep track of your pension? Well, it honestly couldn't be simpler. Please keep us up to date with any changes in name or address or your contact details. Your employer doesn't always do this, or if they do, they don't necessarily do it quickly. As long as we know where you are, we can get an annual benefit statement to you. And you should be checking this every year, not only to make sure that your pension is on track and you're going to have the retirement that you want, but you need to check that the information that your employer has provided each year is still correct. So, are the pay figures that we've included in your annual benefit statement about right? If they're correct, then your pension is correct. If there's any issues with it and you think, hang on a minute, I don't think that's what I got paid, you need to tell your employer as quickly as possible so that they can investigate this for you. If they realise they've made a mistake and reported the wrong pay figures to us, they can just send us corrected pay figures and we can update your pension record. But the sooner you do it, the better. How do you check how much you've been paid and whether it's correct? Just check your pay slips or P60. But remember, you need to knock off any expenses or things that you've been paid that you didn't pay pension contributions on. The other thing you need to check, as I said earlier, is your death grant nomination. So we like you to check it regularly because things can change quite substantially over a year. And if you need to update it, again, just fill in a new expression of wish form, or if you've got member online, just log on into the my personal details section, and go in and update it. So that brings us to the end of the presentation. So today we've covered that the LGPS provides you with a safe and secure pension, which is not linked to stocks and shares, and which gives you a guaranteed index linked income which is paid for life. You have the choice to take tax free cash when you retire, and you can retire whenever you want between 55 and 75 at the moment. You can also choose to change how much you pay in, whether that's adding more to your pension or cutting back a bit while times are tough. And that we've also covered that your LGPS pension doesn't just include benefits for you, it also covers life cover and to offer peace of mind for your loved ones. I hope you now have a better understanding of your pension and how it all works. But we here at Essex Pension Fund, we're always on hand to answer your questions. You can reach us by phone or email, and I've put those details on the screen now. You can also find out lots of information about the LGPS on our website, which is essexpensionfund.co.uk, as well as on the national LGPS website, which is lgpsmember.org. Just one quick word about our phones. We've been having some technical issues ever since we moved over from Skype to Teams. Um, Tech services and Microsoft are both investigating, but it's not quite clear why it keeps happening. But sometimes the calls just don't connect or they drop out. So if you have any trouble getting hold of us by phone, just send us an email and ask for us to call you back, and we'll do that. So just include your phone number and the best time to reach you, and we'll be more than happy to phone you and discuss whatever you need to discuss. The pension inquiries inbox is monitored all day during normal office hours, and you usually get a same day response if you email in before 4 p.m. So that is the best way of getting hold of us. So that's it from me. I'm going to stop sharing my screen, and then I'm going to hand over to my colleagues Dan Frost, Sam Jennings, and Joel Elner, and we're going to answer some of the questions that have been emailed in. So let me just, where's my cursor? Here we go. I'm going to stop sharing now. Okay. And let's find, I had a list of questions. We had a few emailed in, but of course we can look at any others. Okay. So the first question is from someone who wants to retire early next year, and they want to know what do they need to do to get their pension paid. So can I pass this one to Dan? Dan, can you pop your camera on and your mic and answer this one for me?
My name's Daniel Frost. I work on the retirements team at Essex Pension Fund. To answer this question, the first thing you need to do is hand in your resignation, your notice. What will happen is then your line manager should upload your leave date on Accrual, and everything the retirement process is driven initially through payroll contacting us, and they would let us know what your leave date is, your reason for leaving, and it's at that point then we'll send you your retirement offer. So you have a retirement pack, if you like. So you have an illustration of your retirement benefits, and there'll be 3 forms for you to complete. We ask for sort of what bank account you want your pension paid into, how you want your pension paid, and we ask you for a little bit of information about any other pensions that you might have in payment at that time. Once we receive your forms back from yourself, and once you receive your final pay packet from ECC, we need to Essex County Council payroll should then provide us with your final pay figures to enable us to run the final calculations through for your pension. Once we've got those pay figures through from ECC, then we can get your pension paid to you.
Excellent, thanks, Dan. Next question. How much does my employer pay in? Can I pass this one over to Sam if I can get you to step in?
Yeah, that's no problem, Jen. So when a lot of people start, one of their first questions is regarding what does my employer pay in and what do I pay in? So, sorry, is anyone else getting an echo or is it just me? 1 second. Is that better? Right, so as Jennifer showed earlier with her calculations, the contributions don't actually have an effect over the value of your pension because that is purely based on your earnings. That's how we calculate someone's benefits. But just in short, to give people a bit of context into what their employer does pay. So your contributions and the employer's contributions essentially cover the cost for you being in the scheme. Every 3 years, this is calculated by an independent actuary. They look at kind of each employer individually, their cost to be in the scheme with their employees to be in the scheme as well. So this can actually vary from employer to employer. So it isn't a set figure like the members' contributions are. They're set at different earning bandings. The employer ones are different per employer. But a general rule of thumb, this isn't 100%, but the general rule of thumb is the employee will cover 1/3 of the cost and the employer will cover 2/3 of the cost. But as I did say, and as Jennifer pointed out earlier, the contributions don't actually have an effect on the value of your pension because that is based on your earnings, but it's covering the cost of you being there, and it's a 1/3 to 2/3 split.
Thanks, Sam. And I think where's my list? There's my list. Yes, Joel, one for you. Definitely one for you. Person's been looking at their annual benefit statement, and their lifetime allowance limit is getting near to 100%. So they want to know how the lifetime allowance used is calculated, and should they be worried that it's getting quite close to the 100%?
Yep. Good afternoon, everyone. Yeah, I'm Joel from our technical hub, and these are sort of some of the questions that do get passed on to our area. So the short answer and how the lifetime allowance amount is calculated, it is your annual pension entitlement times by a factor of 20, and then we add to that your lump sum entitlement. So then what we on the ABS that you get, obviously that amount is then compared to the current lifetime allowance limit, which is 1,073,100. The current PM, Rishi Sunak, when he was the Chancellor back in 2021 and in his spring budget, he actually confirmed that LTA limit is going to be frozen now until April 2026. Prior to that, we had several years where it was linked to CPI. So that's frozen. So really what you need to bear in mind, lifetime allowance only applies at the point in which your pension benefits are paid. But it is worthwhile keeping a track of the value of your pension benefits and having an awareness of the implications should you exceed the limit. So on the annual benefit statement, the lifetime allowance used amount is calculated on the current unreduced value of your pension benefits. So it's worth bearing in mind, should you be considering to retire earlier than your normal pension age, if you take into account any applicable early retirement reductions, this could have a significant difference to the value of your pension benefits. And I've been answering some of the questions that have been coming through, and some people have been asking about early retirement reductions. So if you click on the link, you can see it's quite significant. Let's say, for example, someone's normal pension age was 68 and they wanted to go at 55. The reduction factor is sort of around about, I think it's about 46%. But clearly, if you only went like a year before, those factors do drop down to about 5%. But it's worth bearing in mind if you're comparing that, look at the value of benefits on retirement. So what are the implications of exceeding the LTA limit? When you take your pension benefits, if the capital value of pension benefits is more than your available lifetime allowance, you will have to pay a tax charge, but only on the excess amount. And you have got options on how much that tax charge is. It depends on the option you choose. If you choose to take the excess pension as pension, the tax charge is 25% of the capital value of the excess pension. Should you choose to take the excess pension as a lump sum, the tax charge is 55%. But you can choose to pay this charge either by a reduction to your lump sum when you retire, or you can choose to pay it to HMRC directly to yourself, or you can ask Essex Pension Fund to pay the tax charge to you in return for a permanent reduction to apply to your pension. This is called a lifetime allowance debit. That's quite a useful thing if people are in this scenario, in this case. At the point of retiring, we will give you all the information to do with lifetime allowance and possible payment options. But sometimes, if it is a significant charge, obviously people probably don't want to pay it all in one hit. If you've got this option where the scheme can pay it for you with a reduction to your pension, that's a good function of the scheme. Where the within the LGPS, however, there are options where you could make decisions which could reduce your pension benefits at retirement. One actually is when you retire is pension conversion. So if you were to elect to reduce your pension to provide a bigger lump sum, this actually has the effect of reducing the capital value of your pension. So if you were slightly over the 100%, it may be if you did a little bit of pension conversion, that may bring you beneath the limit. Another option is the 50/50 section of the scheme. If you were to join that, that would reduce the rate for future pension accrual. And then maybe the more sort of drastic option would be to completely opt out of the scheme. So if you were to do that, you would then be entitled to a deferred pension benefit. And maybe on ceasing employment, you could then choose to have those deferred benefits paid. But also, you wouldn't be getting any future accrual from the date in which you opt out. I think an important thing to point out, though, is before you make any decision that affects your pension liabilities, you should really be considering to get independent financial advice. But if this is an area of concern for you, lifetime allowance, I'll say we've got a technical hub. More than happy for you to contact us, and we'll answer any direct queries, personal queries you may have.
Yes, I think it's fair to say it's a highly technical area of the LGPS regs, and thankfully it doesn't impact on a huge number of people in the LGPS. But if you do get impacted by this, it's fair to say you have options, and we're on hand to explain those options to you at the point it becomes a concern. But yeah, like Joel says, if you've got questions about your lifetime allowance limits, we're your people. Just give us an email and we'll get to the bottom of it for you. Thanks, Joel. I think we're going to go back to Dan now. I think this might have come up a couple of times in the chat as well. So we've got a question about what is Member Online and how can we register for it? So is Dan there?
Hello. So yeah, Member Online, it's been talked about actually quite a lot on the chat today, which is quite handy. But yeah, it's the EPF Member Online. You can register on there, and you'll get a code sent to I think it's sent through post to your home address, and then you can fully register once you've received that code. Unfortunately, it's quite new, so it's at the moment it's quite basic in what you can do on there. So, for example, if you're in the 50/50 scheme, it doesn't provide a provisional quote or anything, figures for if you're in a 50/50 scheme. However, it is quite a really good tool if you're in the main section scheme and you want to get sort of a rough idea of, say, taking a pension when you're 60 or 55 or whenever. You can look on there. Then you can contact us if you want some more sort of accurate. If you've got sort of a date in mind from looking at the Member Online, you can then contact us for a more accurate provisional quote, which will hopefully confirm that the figures are correct. And yeah, at that point, you can then go on to retire, hand in your resignation and retire. You can also update your nomination details online on the EPF Online. I believe you can do your address as well. Yeah, so it's a really good tool, and it's always it's sort of being reviewed constantly, developed constantly as well to try and sort of bring it up to date, and so you can do a lot more with it. And that's it. But yeah, back to you, Jen. Thank you.
Excellent, thanks, Dan. Yeah, so I'll say it's this online digital platform that we're developing. So we're constantly evolving new things. So it's always worth checking back to see what new things we've added. But we do have so many members that we are rolling out registration. So you might just get a letter through the post saying, "Hey, do you want to register for Member Online?" But if you haven't had that yet, you can just ping us an email and we'll make sure you're included in the next round of, of invitations as they go out. So, Sam, next question's for you. What happens if I leave my job and I start a new job and their pension's not with the LGPS, it's with a different pension scheme? Can I transfer my pension over?
Yes, so this is the team I work on. I essentially work on the team that deal with people who have deferred pension. So I deal a lot with transfer outs. So that is an option you have. The LGPS don't not allow transfer outs to defined contribution schemes. The government recently had put in sort of extra security steps. So if you do want to transfer out to a defined contribution scheme, it is a slightly longer process than it used to be, but it is purely for the security of your pension that you've built up. So there is kind of extra due diligence we do. So one of the things we have quite a lot of is if you have multiple LGPS pensions or even just one that combined equal to over £30,000, you do have to get financial advice if you do want to transfer that out to a defined contribution scheme. So that's one of the steps that the government put in, that you're no longer able to transfer out to a defined contribution scheme without financial advice if your pension, your transfer values combined or individually in one are over £30,000. The process itself, best thing to do if you are considering this in the future, go to your current pension provider, give them a letter of authority so they can request the information from us. They will send across a request of everything they need from us. We will send them we'll actually send it directly to you now. We'll send you the figures you need and the forms you need to complete the first step. You can then pass that transfer value onto the other scheme for them to do their calculations, or if you choose you want to transfer it elsewhere, you've then got them figures to pass on to whoever you wish. Once we've received those forms back from yourself, we will then write to yourself again with your final election form and to the other scheme with their discharge forms that they need to complete to allow us to make the transfer. Once we've received all that, we essentially, again, do further due diligence, making sure they're registered with the FCA, everything's sort of legal and above board. That's the only reason we wouldn't transfer one, is if it is going to a scheme that we think is a scam or isn't fully registered. But yeah, it's not an easy process, but it's everything that's there is something that's needed and required by government. We don't have extra steps just for the sake of having extra steps, but that is something that you can do. And on a slightly different note, it isn't in regards to transfer into another scheme, but it was asked a few times in the chat. You do have a deferred pension with us and you have rejoined, you can combine those. We should automatically write to you regarding that, but that is something that can happen unless the deferred record was based off an opt-out after 2015. That's the only time you can't, but that is another thing. You can combine your LGPS records and LGPSs from other funds as well. So if you're with Hertfordshire or Kent, that can be looked into as well. Brilliant.
Excellent. Thanks, Sam. So yeah, I think what Sam's trying to say is that you can transfer out, but it's a big decision. Defined benefit pension schemes are generally considered to be give you better value for money than other types of schemes, which are generally the other type are called defined contributions, where you pay in. If it's an occupational scheme, your employer pays in, and the money is just invested, and you just get a pot of money at the end to make some decisions with. So it can be a bit of a long drawn out process, but as we say, it's because there's a lot of due diligence and we're checking to make sure that your money stays safe. Because once you've transferred, you can't reverse that. So we have to make sure that it's going to a legit place. All right, back with Joel. Let me just find which question. Right, okay, Joel. This one actually came in this morning. So a member who's considering buying extra pension through an additional pension contribution, so APC. They want to know if the amount that they're buying is paid at their normal pension age or whether it can be taken earlier, and what happens to the extra pension they've bought when they die.
Okay, yep, I'm back again. Yes, any APC that a member buys is linked to your normal pension age. So for most of us, that can be age 67 or 68. But yeah, members can retire from the age of 55, and when you do retire, the APC will be paid all your pension benefits. But if you retire earlier, obviously early retirement reductions will apply to that APC. So going back to where I mentioned earlier, let's say, for example, your normal pension age was 68, but you retire at 55, whatever APC you purchased unfortunately, there would be an early retirement reduction of around about 46% applied to that. So the closer you retire to your normal pension age, the reduction is less, and if you actually retire normal pension age, no reduction at all. With an APC, that is a pension, additional pension just for you. There's no provision for survivor pensions. So unfortunately, at the point, if you were to die, that would not be passed on to a survivor. Back to you,
Okay,
Jen.
thanks very much. Brilliant. Okay. So yeah, we did touch on some of that, but it's always worth revisiting just to clarify. Um, so yeah, I think those were all the questions that we had in advance. We can have a quick look. Some of the questions in the chat. Is there any benefit to retiring but not taking your pension straight away? Yeah, so yeah, does it carry on accruing or have any additional payments to it? I think this one might be a Dan. It's a retirement question for the retirement boss. So yeah, Dan, is there any benefit to retiring but then deferring the pension, so not taking it straight away?
So yeah, you wouldn't necessarily accrue any more pension. A deferred pension would increase the same way a pension in payment would increase, in line with the consumer price index that is applied every April. However, as Joel mentioned earlier, the closer you get to your normal pension age, so 65 or your state pension age, the reduction applied to your pension would be less. And if you were to retire after your normal pension age, so you can defer it till the day before your 75th birthday if you wanted to. A small, from the day after your normal pension age up until the day before your 75th birthday, a small increase is actually applied, like a late retirement enhancement increase is applied to your pension. So yeah, it's not for us to say if it's worth deferring it or not. It's one of those things that you'd have to sort of, once you've left the scheme, look at the retirement offer that you've been given at the time, and then maybe that'll illustrate any reductions that were applied to that pension at that time as well, at the date of leaving. And you've got a better idea once you've got those figures in front of you whether it's worth actually taking a pension now or actually deferring payment of the pension to a later date. Yeah.
Thanks, Dan. Yeah, so it's that's the thing about pensions, it is so personal to your own circumstances, but it's certainly one of the options you can look at. And once you've got the figures in front of you, it becomes easier to make a decision. I think we've got almost out of time, so we'll do one last question and then we'll say goodbye. So, I can see one that says, "Did I read that the survivor's pension is about half?" Joel, do you want to just quickly jump in on that one? Just very quickly about survivor pension as a percentage.
Yeah, the LGPS scheme has changed over the years, and some of the benefits have changed as well. I'm trying to think now. Yeah, our final salary linked pension benefits that went up to 2014. Those, well, actually, those up to 2008 were a 50% accrual, but then the factor has changed for subsequent portions of pension. Whereas I think right now, what are we at? Is it 30? I think it's just over 30% in the care scheme. Yeah. So yeah, but if you wanted some information on what your survivor pension benefits could be, you can write into us and we could always give you sort of an illustration of what those are. Now, something worth bearing in mind is if you do retire early, obviously there's a reduction applied to your pension, but that is not passed on to your survivor. So effectively their entitlement would be calculated on your unreduced pension benefit.
And I'm just going to jump in with one thing because I know we get this question a lot. If you are single, so you don't leave a spouse or a partner when you pass away, your pension, that pension just doesn't get paid, because the surviving partner pension is a proportion of your pension that continues to be paid after you've passed. It's not an extra sum of money. So unfortunately, if you don't have a spouse at retirement, we can't add that to your pension. We get that question quite a lot, but it is a separate sort of issue. All right, well, we are out of time. So thank you ever so much for coming along today. I really do hope you found it useful. If we weren't able to get to your question, please email us. So you can either email pension inquiries at essex.gov.uk. If it's a little more technical, you can also go for pensions.technical@essex.gov.uk. We'll get back to you with all the answers. But thank you so much for joining, and I hope that's answered a lot of your questions today. Say goodbye. Thanks. Bye.